Now we're going to look at what's happening with U.S. exports and abroad, and where some of this physical market movements, and we'll go through some of the physical pricing and some of the slowdowns that we're seeing into Asia that we've been talking about, and now they're starting to really show up in the data points. So first, let's take exports. So gasoline had a drop of 24,000 barrels a day. Again, not surprising given the demand in the U.S., the need to backfill. So that's going to remain that overhang, especially as Europe continues to export into not only our market, but we're seeing more competition into Latin America, which is going to keep that some of those exports hindered. Distillate had a small bounce of about 119,000 barrels a day. That's something that will remain depressed just because we continue to see the exports from Europe, and that's typically the U.S. sends into Europe, and if the Europe's sending into the U.S., then the arbitrage doesn't make a whole lot of sense. So that's going to keep these fairly capped in general. It'll stay a little bit elevated versus the low that we saw from the February 19th, but it'll just be still depressed in general. Now, LPG had a small drop down. Well, I shouldn't say small. It was 574,000 barrels a day. That will reverse. Just again, there's a timing thing behind that, which will put a bit more into the market. Now, on the crude export side, there was only a small uptick of about 37,000 barrels, which if you look at where we are, we had that drop of about, we exported about 2.35 million. Now, we expect an increase for the first week, as we come into March. So there will be a spike. Two reasons. One, just in terms of timing of loadings, but also just the way the market is working in backwardation versus contango. So this is something that instead of loading at the back end of the front month, first month, you'll do second month. And that's where we'll see that movement. Not only will you have the delays from the Texas blackout, but you'll also have some of that timing delays just in terms of pricing. So that will reverse. It just won't reverse to previous highs just because we don't have the same level of demand for our crude that we have in general. And what do I mean by that? So crude exports from Louisiana offshore supertanker port, or the Loop, tumbled to zero as Asian buyers limited purchases to manage high inventories on their side. The lack of shipments in February from the Loop for the first time in nearly 2 years is a stark contrast to, from January, when the facility saw exports of 15 million barrels of domestic crude into China, South Korea, India. So that's where we start to see some of these slowdowns, where Asia just isn't buying as much, not only from the U.S., but also from other places in the world, which again is telling that different story, which is why we'll see an increase in exports, but it's going to be a measured increase, which will keep more of our crude in storage, again, keeping those levels elevated in terms of, instead of seeing those draws that we've continued to see, because those exports will leave more product in storage. And then just coming from one of the analysts out there, interest for U.S. oil might return later in March, as those supplies would arrive in China during May and June, when most turnarounds are completed. So when we look at, and we'll talk about this in a few minutes, when we look at turnarounds are increasing in China just because they were delayed with COVID as they tried to maintain operation. Now a lot of those turnarounds that were delayed are going to come to pass, as we go through April and into May, and then into the back of June, and that will reduce some of that oil demand that I think was expected to continue to go into China in the near term. This is just looking at the gasoline exports over the last 9 years. Here's that steady move down. We'll still continue. We don't think it'll be a stark drop, but it'll still continue to trend below that 9-year average as there's more demand within the U.S. and pricing makes sense to stay local. Distillate, as we were saying, we were going to get a small bounce, but we're still well below the bottom of that cloud. And now that we had that little bounce, we're just going to go sideways from here. Maybe we get closer to the bottom of the cloud in terms of that bottom of the 9-year demand levels, but there won't be too much to show in terms of just where that demand's going to be. Here, where you can see how the crude oil export is pretty much flatlined, and there will be a bounce closer to that 2 points, let's say 2.7, 2.8. Maybe we can get back to the 3 million mark, but it'll still average back down closer to that 2.7, 2.6 million over the next few weeks. And then here's that big drop that we saw in LPG. Obviously, we were coming from those highs. Now we drop down below that 5-year average. Then we'll pop back up. It'll just stay at above that 5-year average and closer to the top of that cloud in general. Now, one of the benefits that we saw, and we'll talk about Genscape ARA data, just because we had some timing delays. So we had a nice drawdown of European crude stock, but we did have an unseasonally increase in floating storage. It's just going to be a timing delay of how quickly can it go from floating to onshore. So this should start to reverse, but again, it's not going to reverse aggressively. It's just gonna start to go a pretty steady increase back up. But when you look at that 5-year average, then there's normally an increase back up. So again, we're not doing anything too crazy against that 5-year average. And then when we look at Fujairah, there was essentially everything that was built last week is now drawn down, and we'll go through some of the specifics. So when we look at what the numbers are, so Fujairah had about 20.8 million barrels in storage. Total stocks fell by about 2.3 million, which was largely offset last week. It didn't completely offset it, but again, it drew it down. The draw was about 10.1% week on week. So light distillates saw a draw of 952,000 barrels, which was down 11.8% week over week. But when we look at the market in general, the east of Suez gasoline market was finding support with the news that China's state-owned refiners are going to have a large maintenance program. That's going to start to push a bit more into the Chinese markets. But then when we look at Chinese demand in general, they're actually at a very elevated level for this time of year for their gasoline and diesel, which is a little concerning on the refined product side. So that's going to mitigate some of that movement. And then when we look at stocks and middle distillate, rose by 56,000 barrels, rising to 4.2, up 1.4% on the week. The gas oil market remained under pressure as more flows from the Arabian Gulf and India were heading towards Singapore. Again, there's a big problem where there's a structural weakness in that middle distillate side, which we'll talk about in a minute, on India diesel demand. But then when we look at the other side of the heavy residual fell by 1.5 million barrels a day, or 13.1%. And it's just there was that knock-on effect where crude prices came down, so then those resid prices got a little bit better, and guys looked to quickly snap those up. That will start to reverse a bit, but again, that's a net positive in terms of traders taking advantage of some of the softness in the residual market. Then when we look at the physical market or the crude loadings, here you can see Russia remains elevated for March. They're now back above their January numbers. Norway remains fairly stable. This should get to about 1.6 million, but again, very close to where it is now. Nigeria will continue to add barrels. Angola is fairly stable at this point, just because they're struggling to sell their crude into the market, and we'll talk about that in a minute. And then when we look at Libya is maintaining that about 1.2 million barrels a day into the market, where the Congo is still struggling to clear some of these cargoes, and Libya has actually cut their OSPs, or their official selling price, to try to clear more crude into the market, which is supporting some refinery cracks in Europe, especially as Urals are trading at that 10-month low continuously. So there's some movements here where the balance is going to be, how does OPEC respond going into not so much March, but into April, and will we start to see Saudi Arabia adjust some of those, the million barrels that they added at the end of January as we went into February and March. And again, that's going to be kind of that back and forth. So when we think about where the exports are so far, so West African oil exports to Asia this month are going to drop to their lowest level since October. Shipments to China are set to decline to their lowest level since August. while exports to India are also set to dip. This is just based on where things are moving at the moment, and that's why we think there's going to be that buildup in some of the floating storage. China Lunar New Year, air passenger fell by 45%. Again, there's some of those big drop downs in general. Then flows to China in February are estimated at 34 cargoes. That's the lowest since August. That's also revised from the movements of 1.22 million barrels. And these are things that are continuing as we've talked about with the CPC side and some of the other blends. We continue to see some of the pressure coming into the market in general. We'll provide some updates in terms of pricing. So then when we look at February loading, so Libya again cut their OSP to dated crude by $2. Urals still trading at a 10-month low in late February, which has carried over into March so far, trading closer to about $2.35 below dated Brent. CPC blend, again, 10-month low on the Platts window. We're seeing some of those cargoes they've sold for the loadings March 9th to 13th at $2.75 less dated Brent, again, weighing on some of that physical. And that's the traded price is the lowest since end of April, and it's compared to $2.45 and $2.50 at the end of Feb. ESPO strengthened in February after trading in January at the lowest premium to Dubai in 4 months. But even though it's had a bounce, it's still at a fairly low level, with the grade sold February 19th at a premium of $2 to $2.25, which is $1 higher than the low on January 19th. But that has so far started to pare back. Now, the Angolan side is where the concern comes in, because we've actually seen a reoffer on some of the weaker sales, where Unipec has reoffered several cargoes, about 6 of their allocation. They had 9, so they're going to take 3 and reoffer 6. And then Senegal offered to sell 950,000 barrels on consignment for crude in April, and they actually took the price down, and now it's 10 cents below dated Brent, which is a bigger discount than we've seen before over the last few months, which if Nigeria and West Africa and Angola are struggling, Congo struggling, and then the U.S. is seeing that dip, this points to, again, a bit more of headwinds for demand going into Asia, which will push back and reverberate through the system. And then when we look at crude oil on the water, we're still above that 5-year average. We're still, and then just based on what we're saying, this is going to start to increase. But you have to weigh what is it going to increase with, because oil in transit will continue to slow, but we will start to see that show up in crude oil and floating storage. Now, the bottlenecks have abated in China, which will pull some of this crude off the water faster. But we're already at over 100 days of crude in storage in China. We have an increase in refinery maintenance coming up. This will put a headwind into some of this Chinese demand, which will again push back on the system. South Korea is still at lows, Japan's still at lows, and India is really the only bright spot right now, but even that's starting to pare back, and we'll talk about that more in a minute. Here's where we look at crude oil in transit. This is just going to follow that 5-year average. There's not much to say in general that we're not going to just continue to hold this line here, where as we've been saying with this spike at this level, here you can see that we had that little bit of a bump. Crude oil and floating storage remains elevated, and we just don't see that really stopping, where we'll continue to stay at the top of that range and really start to increase at a pretty stable level, just as we have that timing delay in Europe. That'll start to abate, but it's just going to be as boats show up in Europe and in Asia, how quickly can they get offloaded. Then when we look at those Iraqi exports, this is what we were talking about when we look at Feb, where they were supposed to come down. They actually had an increase in flow through for February, which it's just going to be a bit concerning as we go into the OPEC meeting. So Iraq boosted oil sales to the highest since May, even with the country committed to production targets lower than its OPEC plus quota. Exports rose 3% in February to 3.385 million barrels a day versus 3.3 in January. So this is going to be a topic of conversation. And not that anyone's going to really say anything, because Iraq walked away from the Chinese deal that would have pulled some money in, just because they were trying to take advantage of the stronger pricing for some of those movements, where even though some of the differentials remain soft, they're still elevated just given where we're priced off of from that dated Brent level. So this is something that we'll continue to see. But as we go into March, and we're starting to see a little bit more builds on the floating side as we turn to the Middle East. So this is going to be a bit of a concern, especially on the physical side. So when you think about OPEC, why would OPEC increase production when they could just cut official selling prices? Because the cutting official selling prices would help the refining side, because when we turn to India, India has requested that they increase production because they have gasoline prices at all-time highs, diesel prices near all-time highs, and they can't afford to cut taxes. Now, even though they can't afford it, they've talked about doing it just because they're starting to see the impacts on not so much on not just on an inflation side, but just consumers slowing down their purchases because the price has gotten out of hand. Now, if you cut OSPs, then that makes the feedstock cheaper into the refiner and then makes that end stock cheaper as well, which would also achieve the same goal as putting more production into the market. But again, the question is how tight is the market in general? Then when we look at the gas oil side, we're still staying at this 17-year average. And this is just because they're importing less, they're exporting more. They have some refiners coming back online. So this is going to hold at this average level as they try to manage some of that flow through. On the gasoline side, we're still at that right off of all-time highs. This will continue to move lower. Even though demand remains very weak in Europe, there's still a very healthy export market coming into the U.S. and other markets of West Africa and Latin America, which again will keep some of those movements leaving the country and into the markets in general. This is looking at Singapore. So Singapore remains elevated in general and is trending higher. Just given some of the backdrops that we're seeing in the market, this will stay fairly stable on the aggregate. But when we start breaking it down, again, the middle distillate side is the most concerning, where we still are setting those seasonally adjusted all-time highs. And just based on the demand levels, where diesel demand is weakening in India, diesel demand is fairly is down. But when we look at China, their storage is very elevated, so they're going to try to work off of that storage, which is going to leave more of this product in Singapore. We should see some of it come into the U.S. market, especially onto Pad 5. But this is going to take time just because we're not seeing a lot of those movements yet. Gasoline, when we look at light distillates, this is going to be a bit more of a back and forth, and this will stay fairly flattish. So the sale, and just putting some numbers around the comments I made on India, the sale of diesel, the country's most used, dropped 8.6% in February from a year earlier, according to early estimates. LPG gas was the only fuel that saw a year-over-year rise, surging 7.6%, which isn't surprising based on what we've been saying. But gasoline sales last month fell 2% from a year earlier, and based on early, what March is looking like right now, the sale of diesel and gasoline are seeing kind of a steady decline. Not this huge decline, but gasoline is seeing a little bit of a dip, and we're seeing that continue so far, just based on what the prices are, and the same can be said for diesel. Now, when we look at Brent time spreads, now we've shifted over, and this should actually be we're in April into May, and here you can see just where we sit right now. It's come back a bit. We think it'll find a bit support in this level, but we're starting to see some of these. Some of the spreads start to pare back a bit as prices obviously spiked up. Now there's a little bit of a competition as to where does this go over the next month or two heading into the OPEC meeting. Now, when we look at refinery margins into Asia, you see Singapore has really kind of normalized, and they're struggling to see some of this breakout again coming to some of these competing factions as we look at the demand market, which Asia is a little bit on the lower end. And this is where we look at the hydrocracking just to see where are we on the seasonal level. We still remain at seasonally adjusted lows. with really not too much changing in the near term on the Asian side. But when we look at Urals, as we were talking about, they've been trading at that 10-month low. That has helped incentivize some additional runs into the market. And by trading at such a discount off of physical, off of the screens, and what's trading in physical is also helping the margins on the back end, because you're getting it for less, which means that you can charge a little bit less than what's in the market, but you can still get a little bit closer, and you can undercut and pick up some of that margin in between. And this is showing something very similar in the Mediterranean. But you can see that even though we're seeing some of this spike, we're not to where we were pre-COVID. Even though on a seasonal level, that's really where we should be seeing in terms of these increases. It's just the demand really isn't there, even with some of that discount. And then when we look at imports into China, you're starting to see those super tankers slow a bit. This is something that's going to continue to walk down as they show up and turn into floating storage. Now, when we look at that Asian floating storage, here's where the blip up is going to continue to move higher. And it'll just, how high we get will be indicative of what are some of the bottlenecks look like, and how quickly are they overwhelming some of the issues in the near term. Because when we look at South Korean oil imports, South Korea crude imports fell 14.7% in February from a year ago, falling to 73 million barrels from 88 million barrels a year earlier. So you can see January here in terms of where we were on that 3.9. So when we look at where we are today, we're just below the 2017 number. So we had a little bit of a bounce off of January, but we're still well off of the average of 6.3 million, which is something to consider as we look at how their COVID cases still remain elevated. People are still doing a little bit less, which will be a headwind for some of that Asian demand. Now, North Sea oil, as we were saying, we had that spike up. This is starting to move a bit more into the market, but the North Sea is starting to cool a little bit. It's still probably the best place in the physical market right now when we look at spreads. But that premium has started to come down. We're starting to see a little bit of a slowdown, which is leaving a little bit more into storage. This will move closer to the 5-year average, but still remain at the top end of the range in general. Now, West Africa saw that healthy drop. We had some pretty steep discounts coming to the Nigerian spreads, and now we have an Angolan cargo coming cheaper just to try to clear the rest of March. That points to some additional problems. Now, even though we are seeing a bit more that are sitting offshore, it'll just come closer to the 5-year average, and then we'll have to kind of reassess on what are some of these sales look like, because they still remain fairly slow in general. And we're still picking up more loadings that will come into March and into April in general. So then when we look at Middle East, this is something where it's staying within that net average, and we should see that start to increase and just remain at the elevated level of that range. And then here's where we were talking about with Europe on offshore versus onshore. We're back at the top of the range. This will fall back down closer to the 5-year average as it goes from boat onto onshore. But then when we look at China, this is what we were talking about, where now we're at a seasonally adjusted high for crude on the teapot side. And just based on the timing delays of some of these runs and some of this pull through, this is going to remain elevated and stay at the top of that range in general. And when we look at fuel oil stocks, they remain well above the seasonal norm. And that's something that's going to continue, as articles have been coming out about, and we'll write about in our write-up that's coming out on Friday, just talking about what does the gasoline diesel market look like in China. And do we see any real changes? And we'll cover some of that economic demand in the Econ show. So I know we covered a lot. If you have any questions, we always appreciate the comments. It's going to be another sloppy number as we go into the end of this week, and then even into next week. And then we'll start to see a bit more of a normalcy as some of these headwinds from obviously inclement weather, but also the Texas power outage start to abate. So thanks again for watching. We have a busy week that's coming up. We have the Econ show, and then we have the Frac Spread Count show, where we'll also cover part of OPEC. So we look forward to helping you out with your planning on a corporate side, investment side, because we do enjoy these shows. So please remember, like, share, subscribe. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.